Hello, everyone. My name is Francisco Mainez. I'm very happy to be part of this thrilling event. I'm going to speak a little bit about the importance of KYC, of know your customer, and the data that we should be capturing and how we should be doing for our merchants and customers. And I'll provide a practical example of when things go wrong, but not too bad. I'm currently the head of financial crime and payments digital transformation in a payments company called Ecommpay. I've been here over the last 2 months, and my job here is to guide the company into a digital transformation program, not only for onboarding merchants, but especially on financial crime controls and all aspects related to it, sanctions, fraud, and money laundering and transaction monitoring in particular. Previous to that, I was the head of financial crime risk data and analytics in one of the lines of business for HSBC in retail and private banking. I'm not a banker by trade. Prior to HSBC, I was in another bank called Standard Chartered, but I'm not a banker by trade. Professionally, we can say that I grew up doing military intelligence for NATO and the European Union in different missions. But essentially, the job has always been about, how can we get the data that we need to provide a better assessment to the guys that are going to take the decision, to the senior decision makers. So without further ado, we'll go for the presentation. And essentially what I would like to talk first is a series of pointers about, how KYC is still very important. It's something that we cannot just delegate to machines to do it. There has to be a human component behind it. But over and above, it has to be a very strong planning behind it in the sense of, and I'll come to that with an example in the next slide, of how important it is to plan ahead. What is the data that you need to collect on your customers? So basically, you're looking at, you're going to need a very robust and effective framework. It's not indiscriminate. It's not about just capturing data just for the sake of doing it, because actually that can also put you in conflict with regulations like GDPR. But it has to be data driven. 20 years ago, we didn't have the power, the computer power and the storage power that we have now, but the need is still there. As companies, as entities, or even as individuals, we generate vast amounts of data. So now we have the power to harness it, but you have to come up with a plan. It's not about just capturing data and then trying to find a place for it. It has to be targeted, and it has to be perpetual, because anybody in the financial service industry, you want to prevent fraud. What you want to detect is any change in behavior going from normal to suspicious, or any anomalies from the very beginning. If you detect it when the fraudsters or the money launderers have been operating under your skin, after 6 months, then you're already deep into the problem. Your data capture and your KYC has to be aligned with other elements in your financial crime framework. And then there's a question for you. Is this transaction monitoring talking to you? And I'll give you an example. Imagine that now you finish university, you graduate, you join a big company as a university graduate, and you get a salary of XYZ a month, or sorry, XYZ a year. So let's say $50,000 US a year. Now, you're going to join that institution as a customer or as an entity, and that's what you're going to tell your KYC system. That's what the KYC system will record of you. Now, fast forward 5 years, and you become a quite successful senior manager. You probably have a salary that now is about $90,000 a year, and you probably bought a villa in southern Spain, and you're making payments to satisfy the mortgages of that small villa. What's going to happen is that because your transaction monitoring doesn't know that your KYC has evolved, your transaction monitoring system will produce alerts saying this is not the behavior from this customer, because this customer is on 50 grand a year with that level of income. This is not normal. The KYC system doesn't know that your profile has evolved. So that's why it needs to be perpetual. That's why it needs to be updated, and it always has to be looking for anomalies. And more importantly, it cannot operate in isolation. It has to be talking to other systems. It has to be talking to system with fraud to measure biometrics, for example, and the possibility of incurring in particular typologies like synthetic identities. It has to be talking to your cyber risk systems, for example. In terms of KYC, going back to the main subject, there's been a lot of developments in this area. Typically, you would have a few years ago systems are still working on rigid rules-based solutions. Now you have advanced analytics that can help you with that. And in one of the previous roles, what we implemented was an algorithm that essentially looks at a KYC profile of a customer and doesn't take decisions based on a single factor. So for example, if you move from country A to country B, what's going to happen is that your bank or your financial institution will probably trigger a review on you. Now, that's in the old rigid rules-based system, or the old days, or when those systems were basically the only thing we have. Now, with the power of analytics, you can actually call that a risk event or a risk indicator, and you can embed those risk events, moving to another country, transacting with virtual currencies, transacting with high-risk jurisdictions, into an algorithm, and the algorithm is going to give you a score. And depending on that score, there'll be a treatment. So going back to the previous example where you move from country A to country B, with the algorithm, you're not going to be reviewed as a customer. That costs a lot of money, from an operational perspective. And now you'll be given a score, and the score will likely say, we don't need to review this customer. And what I was going to say is that now you multiply that by X many thousands, and imagine how much you're saving to your institution thanks to analytics and those algorithms. You got to get it right, because if you don't get it right at the beginning and you keep onboarding customers, you're going to run into a big problem that then is going to cost you a lot to remediate. And it's very common to see large institutions, or not even not necessarily that large, having to get the services of a consultancy company in order to remediate KYC, in their customer population. And I'm going to give you an example now on how how is crucially important to get it right, and how it's so important to plan ahead. Sorry, what data you need to collect on those customers. So you see those two profiles. The data is not really, the data is fake, obviously. It's actually truth, as you will see later. It's probably not what I mean fake is that it's not probably the data that you will collect, but it's an example of how if you keep collecting the same data and you generate the same profiles, you're going to be open to to surprise, as we'll say in a minute. So you need to plan what data needs to be collected. You need to determine within that data collected, which are your critical data elements, which are those unique identifiers, which are the data points that when they will change, it'll trigger an onboarding event. It'll trigger KYC review, for example, or it'll trigger full investigation on the customer. You need to cross-check with other sources. You have only one system during a political exposed person pepper screening for you. You're open to the risk of relying on a single system. So you should be able to cross-check with other data sources. You need to put the whole thing on refresh. You need to review those sorry. You need to review those KYC profiles, looking for data gaps constantly. You need to be working a lot with your data quality department. And if you don't have it, make sure that there's somebody in your organization that should be able to review the data quality of your KYC profiles. And here's a quick example. A lot of financial crime typologies are related to your work profile. What are you working on? Because that's going to determine your source of wealth, for example. That's going to determine your type of transactional pattern or activity. If you don't have an updated job profile for the customer, for the client, you're going to be incurring in what I described before. When your KYC profile has evolved, you have a better job, you have a bigger job, it has an impact on your salary. But while your KYC system or your transaction monitoring system are working properly in isolation, because they don't talk to each other, it doesn't make sense. And that's actually the ultimate question to this. Does it make sense? All of this data that we see on the right-hand part of the screen, does it make sense? Well, let's see and have a look. So you see here how two identical customer profiles from a data perspective now turn out to be two completely different personalities. And this is when you can bring it all together. And the best way of understanding it is through a practical example. I cannot name companies because there's still a pending investigation, but I can probably describe this case from a high-level perspective, and then you will understand how it's important to get your KYC right. Otherwise, you're going to be believing on a fake profile, whereas the real profile is doing something completely different in the background. So we're talking about a payments company here. You have you're onboarding a merchant. The merchant is an online toy store. He's based in the UK. but the goods, the toys, are being shipped when you purchase them from another country, and that's everything is on their website. It turns out that they never shipped anything. Whenever any potential customers would try to buy toys from these websites, they will probably get an email saying, sorry, we're sold out on that particular item, or we had technical difficulties with the website, we cannot complete the purchase. But after a while, and we'll see what happened later, the company had the payments company had a couple of chargebacks, and they believe that's when the people who put up this fake profile went greedy, because they thought, well, hang on, we're trying to sell something that doesn't exist, but people keep trying to buy it and keep sending us money. We're basically been rejecting the payments, because actually what we're interested in is what we'll say in a minute. But they started to take those payments, and obviously they never shipped. So when when the charges came back, that's when everything, all the alerts, were all the red flags, raised. In reality, the real profile is somebody who was, a gang of individuals that they were selling Viagra online. And it was a very clever system, because as an end user, all you could see is the toy store, but the people actually, the real customers buying Viagra, knew where they had to go. So you're talking about a website that is probably sitting in a dark web, similar site, arrangements or setup, is rerouting the payments to a fake profile. That fake profile is rerouting the payments, and the data is being adapted so the payments company doesn't notice, and the payments company believe that, well, this merchant is still selling toys. It went absolutely fine through the payments company KYC controls system to detect, the reliability of the website, the reliability of the email addresses, the profiles of the beneficiary owner, the directors of the company. And essentially, when those chargebacks triggered, somebody decided to do some data analytics on the customer demographic, and they found out several things. The first one is that almost exclusively all countries that had a payment successfully performed, which essentially meant Viagra, was middle-aged men, which is demographic that typically uses that type of prescription. They were unusually large purchases and amounts, and the investigation determined that one of the first things that they realized is that, hang on, yes, I can probably go to an online toy store and buy expensive goods, but I can also buy very cheap ones. It's very easy here in the UK to, for £10, go to a toy store, buy something, satisfy your kid, and move on. But every single payment was a large volume one, or larger than it should have been for an online toy store. Then there was a full review of the ultimate beneficiary owners, the website, and a network analysis, and we'll see an example later. And then they realized that actually it was a very clever arrangement. Fraud was not in high volumes here. You're not talking about a large amount of chargebacks, but it shows you how it's so important when you're on board the customer or the merchant to take a look at those details. So you probably, some of you are wondering, going back to that question, does it make sense? So me being a European Union citizen living in the UK, I will probably think, well, with everything that has been going on with Brexit, what is the commercial sense of having a company based in the UK at this scale, almost like a family business, and the ships are being good from a European Union country? It really doesn't make sense. So again, only when they analyze those transactions, they were able to get to the bottom of it. It looks funny because obviously, what they were really selling has another type of implications, but it's actually a real case, and it happened in a company. So it reveals again the importance of be careful, when your merchant is probably lying to you, because you need to realize that your fraudsters, your money launderers, will knock at your door or your financial institution with an impeccable KYC profile. They'll never send somebody with a criminal record. They'll never send somebody with a SAR previously filed against this person. They'll present somebody innocuous that only after only a good operator will be able, or in combination with systems and data, will be able to detect. Otherwise, it could be too late. In this case, not very damaging, but it could have been much worse. And this is an example of how you can integrate all that data together in your investigations. And what you can see is a network analysis using a system called Quantexa. I have no affiliation with Quantexa whatsoever. I just put the screen because actually that's a system that we use in HSBC and was very, very effective, very powerful to do precisely this type of analysis, network analysis. It has a very powerful graphic component because actually you can see which are the hubs in your transactions, which are the neighbors to those hubs, what are the cash flows, what are the transactional flows, and the frequency, and you can even evaluate the strength of those links. If it's there's been a link established on a one-off basis, just once, or it's a recurrent basis, it's a frequent thing. And in agile conditions, what you should be able to do is put several layers, and I put 4, for example, there, of different types of data or different types of analysis. So on the one, you had your customer records combined with your transactional and biometric activity, your country footprint, what are those transactions coming or going, what are the companies, what are they based, all the companies and entities implied. Then you combine with another layer, which is, for example, your advanced media monitoring, advanced media watch list. So you cover in your sanctions angle. You may be using paywall sites, for example, Factiva from Reuters. You use other types of data that in some cases they're still not really conventional or not really traditional in the financial service industry. I mean, not long ago, nobody was talking about using geolocation data, but now it's fundamental if you try to find to do investigations based on different typologies like human trafficking, for example. Geolocation is essential for those. You may want to try to investigate the social media profile of your merchant or your customer. Obviously, what is the beneficiary data? One example would be the UK company's house. The data is not validated, but at least it gives you an idea of how reliable could the company be, at least an initial starting point. And then you combine everything. The last layer, we're combining all of those data sets into a network analysis. And you have things like what I mentioned before. What is the strength of those links? What is the neighbor? Who are the neighbors associated to it? Because behind this graph, you can see not only facts, but also patterns. How much this transaction, how often, this transaction repeat themselves in time. And that's what you want to achieve, a multi-source report that covers different angles. That is the ideal position you want to be. And that concludes my presentation. So I would like to thank you very much for your time, and I hope to see you next time.